Welcome. My name is William Fellows, MBA 2006, and I'm very pleased to introduce our guest speaker, Andrew Lo, the Charles E. and Susan T. Harris Professor of Finance and Director of the MIT Laboratory for Financial Engineering. Professor Lo's research is focused on the fundamental aspects of investments and financial markets, including measuring illiquidity risk and hedge fund returns, evolutionary neurobiological models of individual risk preferences, and financial market dynamics, and most recently, new approaches to financial biomedical innovation. Professor Lo has joined us today to discuss a practical way to increase access to such therapies via consumer healthcare loans, and how it reduces the cost for patients while bringing returns for investors. Please join me in welcoming Professor Andrew Lo.
I want to start by thanking Bill for that generous introduction and thank all of you for coming today to this wonderful occasion. You know, I've given many lectures over the years, but I have to say that one of my favorite activities is speaking at these reunion and alumni events because the energy of the alumni are just unparalleled. I've had occasion to interact with many other universities and their student body, and there's just something very special about MIT alums. And I'm not just saying that to flatter you. One proof of concept of this is the fact that on a beautiful sunny day like this, what do we do for our alumni? We hold lectures. And you all come. The other nice thing is it's just such a pleasure to see a number of former students here. You know, unlike the times when you were in class here at Sloan, you're here now by choice. And I feel really grateful that you've chosen to spend the afternoon here with me. You know, I also want to apologize in advance for any of you who've seen other talks that I've given on this subject. So you may hear a little bit of a repeat of some work that I've been doing, but it's a subject that I've become very passionate about over the last several years in ways that I actually never would have expected. As you know, I'm no healthcare expert. My background and training is in financial econometrics, particularly in investments, risk management, and other areas of finance. But over the course of the last few years, I've gotten interested in healthcare. Not surprisingly, one of the benefits of being middle-aged, you start thinking more about these kind of things. But more so because a number of friends and a family member have been dealing with cancer. The first exposure that I had to this, apart from just hearing about it from friends of friends and other sources, was my next-door neighbor. In the year 2000, shortly after my younger son was born, my next-door neighbor was diagnosed with stage 4 melanoma. And at the time, I didn't think anything of it. I figured, isn't that skin cancer? You get a mole removed, what's the big deal? And within 6 months, he was dead at the ripe old age of 44 years old with 2 kids in elementary school. And that really shook me. It woke me up and made me realize that, gee, this is a serious issue. And then after the funeral service and after the months and years passed, forgot about it until more friends started dealing with this issue. And over the course of the last decade, some remarkable things have been going on in the field of cancer therapeutics. So I want to tell you about one particular event that occurred just last year. And the event had to do with this man, which I think most of you recognize, former President Jimmy Carter. In August of last year, President Carter was diagnosed with melanoma, stage 4. In fact, there are tumors in his liver and his brain. And so when I read this, I just assumed that we would be going to a funeral in a few months' time. He was 90 years old at the time he received this diagnosis. And a few months later, another announcement was made by the Carter Foundation, and that announcement in December of last year, his first diagnosis was in August. By December, he had announced that he was cancer-free. Now remember, he had tumors in his liver and his brain. Tumors, stage 4 metastatic melanoma. And even more recently, just a couple of months ago, President Carter said that his oncologist doesn't want to see him anymore. He's cured. Cured. Now, those of you who've dealt with cancer, which I dare say is most of us, either directly or through friends and family, you know that oncologists never like to use the word cure because cancer mutates and can come back with a vengeance. But they're using it now. President Carter, at 91 years of age, is cancer-free. They can't detect any cancer cells in his body, and he's stopped all treatments. Biomedicine is at an inflection point. And that inflection point is due to a number of things, but you should be proud to know that MIT has played an important role. In 2011, Phil Sharp, the biologist and Nobel Prize winner here at MIT, put out a report talking about convergence, the idea of the physical sciences, the life sciences, and engineering all converging to the point where we can actually develop therapies from the lab. And actually, within another few weeks, Phil Sharp, Susan Hockfield, and Tyler Jacks, the head of the Koch Center, is going to be giving an interesting press conference and announcement in Washington, D.C. on how convergence is affecting healthcare directly. And you'll be happy to know that MIT has played an incredibly important role in that, not just from the research, but from a variety of outreach activities and through the entire Kendall Square and greater Boston biomedical community. A lot of these discoveries are happening faster than ever before. We're in the midst of it. This is the world's capital of biomedicine, in case you didn't know. There's some incredible hospitals here, as well as research facilities, and it's really the combination of those two things plus engineering that has actually created this so-called convergence. And I want to just illustrate to you from the financial perspective, since I am, after all, a finance professor, what convergence means to me. So let me show you the stock market performance of the pharma industry, the biotech industry, and the S&P 500. Just by way of comparison, from 1994 to the present. So this is the cumulative growth of those three asset class indexes. Does anybody want to guess which one of these is the S&P? The red or the blue? Not the green, huh? You probably figured that one out yourself. Yeah, you're right. So it's actually the red. The red is the S&P 500. The blue is the pharma industry. And the green is biotech. Now, what's the difference? For those of you who are not in the industry, it took me a while to figure this out too. The pharma industry are large companies that develop many drugs and distribute and market them to patients and doctors around the world. That's big pharma. The biotech industry is comprised of these small companies, initially small, that are engaged in the cutting-edge R&D that ultimately produces the drugs that the big pharma companies will then get FDA approval for and market and distribute to the rest of the world. Biotech is on a tear. Now, it's kind of hard to see this from this graph, but I'm going to show you a different version of the graph, and then a narrative will emerge that I think you'll find very interesting. So this is a graph in logarithmic scale. And the reason that I use a log scale is because on a log plot, the vertical distances correspond to specific rates of return. So a given positive slope is a given rate of return. And you'll see something really interesting here in this graph, particularly when you compare the blue to the green. Now, the blue is the pharma industry, and what you see is during the early 1990s and mid-90s, the pharma industry was actually doing pretty well. It was on a pretty straightforward upward climb and relatively low volatility, so investors like that. But over the course of a 10-year period, from the late 1990s to the early 2000s, the pharma industry actually managed to lose investor value. It destroyed shareholder value over a period of a decade. Many people in the pharma industry call that the lost decade. Very challenging time. The biotech industry, on the other hand, had a very different kind of a profile. The early years for biotech were really crazy roller coaster rides, up, down, up, down. But ever since around this period, the biotech industry has been on an upward slope. Now, of course, the last few months have been very challenging. Biotech has had a retreat, perhaps because it was a little bit too optimistic in terms of the valuations that were given. But nonetheless, the broad strokes suggest that the biotech trends are very, very strong, stronger than both the S&P and the pharma industry. And the inflection point seems to have come around 2003. I drew a line on April the 14th of 2003. Does anybody know what happened on that day? That's right. On April the 14th, 2003, the US government announced that we had successfully sequenced the human genome. And almost like clockwork, on that day, the stock market says, yep, this is going to be big, and the biotech industry takes off. Now, obviously, there are many other effects going on, but that's certainly telling. The ability for us to have sequenced the human genome and created an engineering process of taking basic science into the clinic and into humans. That narrative has characterized the last 10 years. That's why we are now at this inflection point where convergence is happening. So, as the friend and family member of cancer patients, I didn't understand why it was that given all this convergence, why is funding declining, particularly funding for early stage biomedical research? And it is declining. Now, we know that public funding has been declining for years, and there are all sorts of reasons for that that may have nothing to do with the economy, but that's a fact that NIH funding has been going down, both in real and now in nominal terms. But even public market funding, like this biotech boom that was occurring in the IPO market, that really has been focusing on companies that were started 8 to 10 years ago. In terms of new companies being started, that's actually very challenging to right now. The number of venture capitalists in biotech in 2008 was 201. And as of a couple of years ago, that number has come down to 138. We've lost about a third of our biotech VCs. And if you look at the very, very beginnings of biotech companies, the Series A funding for biotech, that's actually the lowest that it's been in about 10 years. Why? Why is this happening when we're on the verge of these incredible breakthroughs, like cures for certain kinds of cancer? And I can't help but think, from an economic point of view, that there's an economic reason. And the economic reason that I conjecture, and over the course of the last few years I've been working on, is this. It's because of increasing risk and uncertainty, particularly surrounding drug development. Now, this takes a little bit of time to really sink your teeth into, so I'll give you a bit of a narrative from a simplistic perspective, and happy to talk about this during the Q&A to get, because I suspect that there are a number of you that are in the industry, and you can tell better than I can what's going on. It turns out that the drug development process is an incredibly complex and lengthy one. It starts with basic scientific research, what's going on in the lab, and once you have something in the lab that you think might serve a useful therapeutic purpose, you've got to test it out because of scientific and ethical reasons. You've got to go deliberately in these various different stages of clinical development. Phase 1 is whether or not it's safe. Are you going to have bad side effects and hurt patients? So you do a small study just to test safety. Phase 2, you now increase the sample size of humans, and now you're looking not just for safety, you've already established that, you're looking for efficacy. Does the drug actually do anything in a smaller patient population? And finally, phase 3, which is the biggest phase of all, has thousands of patients. Now you're looking for broad impact across a large patient population. This process takes 10 to 15 years from beginning to end, and hundreds, if not billions, of dollars. But here's the thing. That process is actually getting harder, not easier. And it's actually getting harder not in spite of, but because we're getting smarter. Now, this is really a weird notion, especially from a financial perspective. Typically, when you get smarter, things should get easier and less risky, right? The more you learn about a company, the less risk there is. That's not how it works in biomedicine. Things are getting harder and more risky thanks to scientific breakthroughs. And here's the evidence. So this upper graph is titled Eroom's Law, and it's a graph of the number of new FDA-approved drugs developed each year per $1 billion of R&D spending year by year. And you can see it's downward sloping. Has anybody ever heard of Professor Eroom? No? Well, that's because there is no Professor Eroom. Eroom is Moore spelled backwards. This is the exact opposite of Moore's law, which says that semiconductors are getting more and more efficient over time. This is on a logarithmic scale. And it shows that the drug industry is getting less efficient over time. Now, it's not because people in the drug industry are incompetent or stupid. On the contrary, they're some of the most talented people in our economy. What's going on? Well, here's a simple little example that I've concocted to make sense of it for myself. Things are getting harder because we're actually getting smarter. And an example of that is combination therapies. How many people have heard of the AIDS cocktail? So this miracle drug that's not just one therapy, but it's 5 antiretroviral drugs put together in a package, each one of which doesn't work particularly well for dealing with AIDS. But when you take all 5 of them together, it works like a charm. It converts a death sentence into a chronic, manageable condition. So we now know that combination therapies are actually effective, in many cases more so than the individual therapies. Well, that suggests that for any kind of a disease we're trying to target, we ought to look for combination therapies, right? So how many combinations do we have to go through? Well, there are 2,800 approved drugs on the market today. 2,800. Suppose we just took pairs of them. Those of you who are in operations research, I'm sure you can tell me off the top of your head, what's 2,800 choose 2? It's a big number. There are 3.9 million pairs out of 2,800 possible drugs, and each of which requires a separate and statistically independent clinical trial, which takes hundreds of millions of dollars, a decade or more, and thousands of patients. And if you think about triplets and quintuplets, I won't go through the various combinations, but you get the basic idea. Now that we know that combination therapies are possible, we are obligated to look into those possibilities. And it makes it harder, more risky, more expensive, more lengthy. As we get smarter, drug development has gotten harder. It all has to do with how investors think about risk and reward, because ultimately somebody has to pay for these clinical trials, and the people who pay for it are basically you and me, shareholders, investors, patients. We're paying for these clinical trials. And the thing about us investors is, as you probably know from your finance class, we like reward, we don't like risk. And so I want to illustrate that to you in a very personal way. Those of you who've taken my class, you've probably seen this, so don't give it away for everybody else. I'm going to ask you to choose one of 4 financial assets for your retirement fund or for your parents' or children's college education fund. I want you to pick one of these 4 financial assets. I'm not going to tell you what they are. I'm not even going to tell you over what time span they occur. I'm simply going to show you the cumulative growth of a $1 investment in each of these 4 assets and ask you to choose one and only one of them. Okay? So, how many of you would like to have the green asset? Okay, we have 1 or 2 people here. Okay, good. The red asset? Any takers? Nobody. All right. The blue asset? Any takers? Okay, those are the hedge fund managers. And how about the black asset? Yeah, right. Everybody else. That's what we want. Well, in fact, let me tell you what these are. These 4 assets, number 1, the green asset, U.S. Treasury bills, safest asset in the world from 1994 to 2008. Doesn't do a whole lot. It turns $1 into $2. The red asset is the S&P 500, which is more risky but more rewarding. None of you picked that, which is odd, by the way, since most of your retirement funding is probably in that. The third asset, the blue asset that a few of you picked, is the single company Pfizer, drug company. Very rewarding, but really risky. That's a real roller coaster ride. And the most popular choice by far is the one that all of the audiences that I've given this example to pick. And in fact, yes, it is the Bernie Madoff Ponzi scheme. And now you know how Madoff got so big. This is absolutely human nature. You can count on it. We like return. We do not like risk. And when confronted with that, we will shrink away from it and move to more attractive assets, lower hanging fruit. Now, I want to start doing a little bit more finance because, after all, this is a finance perspective. I want to argue that risk has a very specific dimension that in finance we tend to talk about, which is idiosyncratic versus systematic. Those of you who've taken my finance class, this will be drilled into your head after the 7th or 8th week of a 15401. Systematic risk is the risk that you can't get rid of. It's like market risk. You can't diversify away from market risk because it is the market. And so if you want to be taking market risk, you better be paid for that service. What about idiosyncratic risk? What about the risk that you can easily diversify? Should you be paid for taking idiosyncratic risk? No, because you don't need to take it. If you've got a portfolio that's got a lot of idiosyncratic risk, you know what? Just buy a lot of other stocks, and the idiosyncratic risk will get diversified away. The example that I give when I teach 401 is doing window washing on one of these Manhattan skyscrapers. Window washers in Manhattan actually get paid a remarkably impressive salary from certain perspectives because it doesn't require a huge amount of training. You do have to have some skill, but it's a matter of risk-taking. Are you willing to be on the 40th floor of a skyscraper on a 2-foot-wide catwalk washing windows as the wind is blowing? Well, if you are, then you will get paid about $60,000 a year. That's the median salary for a New York skyscraper window washer. But suppose you happen to be a window washer that enjoys breakdancing while you wash windows, jumping up and down the catwalk, spinning around, and doing all sorts of conniptions. That's a lot more risky, isn't it? So do you think breakdancing window washers get paid more than $60,000? No, because you don't have to take that risk. It's idiosyncratic risk. So now let me ask you a question. We've seen that we don't like market risk. We have to be paid for it. We like lower volatility, higher yield. Do you think the risk of a particular biomedical project to develop an anti-cancer compound, is that risk idiosyncratic or systematic? It's a tough question. Is the risk of discovering an anti-cancer compound after years of clinical development, does that risk have anything to do with the S&P 500? Is it correlated to the market, or is it likely to be completely random and idiosyncratic? How many people think it's idiosyncratic? How many people think it's systematic? That's exactly my view, too. I think it's got to be purely idiosyncratic, right? So therefore, from your basic 15401 training, what should the beta of a biotech company be? Close to 0 or close to 1? 0. There should be no beta to a biotech company. Therefore, what should the cost of capital be for a biotech company? Low or high? The cost of capital is dictated by the amount of systematic risk. If there's a lot of risk, you got to be paid a lot in order to be willing to take the risk. If there's not a lot of systematic risk, the cost of capital should be low. I'm going to show you now a really interesting puzzle. These are the betas for the pharma industry and the biotech industry. Now, before I show you, let me ask you a question. Do you think pharma companies have a high beta, a regular beta of around 1, or a low beta, below 1? High beta? High beta means that it's going to be moving around a lot more than the market as the market bounces around. Probably not, because whether or not the S&P 500 is up or down, you still have to take your cholesterol pills, right? So in fact, the pharma company's beta is actually typically below 1. Not a lot of fluctuations as a function of the market, but not that far away from the market. It certainly doesn't have a beta of 0, but it's somewhere in the 0.6 to 0.8 range, sort of like Walmart. It's a very consistent kind of a cash flow. All right, now let me show you the biotech beta. Look at that. The biotech betas are typically way above 1. Occasionally, they dip below 1, but then they get above 1 again. To me, as a finance professor, this is a puzzle. I didn't understand this. But I knew it was true. And the reason I knew it was true is because if you ask the question, what is the cost of capital for a biotech company? When a biotech company wants to borrow money or raise money, how much does it have to earn in order to justify its funding? According to Ian Coburn and Josh Lerner, 2 experts in private equity and venture capital, the biotech industry has a 20% or higher cost of capital. That is an outrageously expensive amount of capital. And so as a result, the process of biomedical innovation has become very challenged, given that it's so costly to raise money. That's a puzzle. Why is it the case that it's so hard to raise money for biotech when, in fact, the risks are low? By risks, I don't mean the probability of failure. That's high. What I mean is the systematic risk. The beta should be low because we're talking about scientific risk. And you know what the answer is? It took me a while to figure it out. I figured it out actually because of a rather chance meeting that I had. So when my mother was alive, she was battling lung cancer, and I was introduced to a biotech company right here in Cambridge, a very successful one, developing therapies for a number of diseases, including the one that my mother had. So I was privileged to be introduced to the chief scientific officer, who otherwise would have no interest in meeting or talking to me. And when I met with him, he brought along his chief financial officer, who actually had heard of me, used my textbook in grad school. So I was quite pleased about that. And as part of my discussions, I just thought I'd ask a question to be polite, not knowing anything about their business at the time. I asked the chief scientific officer, does your source of financing have any influence on your scientific agenda? I'll never forget his reaction. He shook his head, ironically, turned to the CFO as if looking for some kind of support, and turned back to me and said, influence? Our source of financing drives our scientific agenda. It drives it. Now, as an economist, I get it. You got to pay for stuff. But as the son of a patient, I was absolutely outraged by that response. Because what does stock market volatility, interest rates, and Fed policy have to do with whether you should cure cancer via angiogenesis inhibition or immunotherapy? Nothing. But it drives their scientific agenda. That's why biotech companies have high betas. It's because financing is a key aspect of their survival. They're using financing to make decisions about the science, when in fact, from my perspective, from the patient's perspective, this is completely backwards. Shouldn't the science drive the financing? You know, if you buy a home and it's a 30-year investment, should you be financing that using credit card debt? No. You get a 30-year mortgage. So why would you be financing a 15-year drug development project with venture capital that requires 2 to 5 year milestones? It's the wrong kind of financing. So here's the real basic economics of developing cancer, and I'll get to what it is that we're doing on the research front. For a typical anti-cancer compound, it takes $200 million in out-of-pocket costs to develop that compound from preclinical times all the way to FDA approval, if you're lucky enough to get there. It takes about 10 years, and the probability of success in cancer is about 5%. That's a 95% failure rate. 95% of the compounds that start out in the preclinical phase never make it to FDA approval. And if you're lucky enough in that 5% to get an anti-cancer compound, that compound will generate revenues of about $2 billion a year from years 11 to 20, because you got a 20-year patent life. It takes 10 years to get FDA approval. The remaining 10 years is what you have left. And $2 billion a year from a years 11 to 20 amortizes to about $12.3 billion in year 10. So let me just repeat the economics. $200 million today. You wait 10 years, roll the dice. With 5% probability, you get a payday of $12.3 billion, which annualizes to a 51% compound annual rate of return. Or with 95% probability, you get minus 100%. How many of you would sign up for this? Not too many. Two people, one of whom is a drug developer, right? Right, Leah? Okay. This is just way too risky. You know, for those of you who are in my 15401 class, let me help you understand this by calculating the mean and standard deviation. The mean is 12%, the standard deviation 423.5%. Nobody wants this. But what we learn in finance is portfolio theory. Put a bunch of these together. Let's say, oh, I don't know, how about 150 of them? Put 150 of them together, and some magic happens. Now, of course, in order to get 150 of them, we need 200 million times 150, or $30 billion. Where are we going to get $30 billion? My answer as an economist is simple. Assume we have $30 billion. I'll come back to that. I'll come back to that. Thank you. Thank you. I'll come back to that. If we had $30 billion, and if the 150 projects are independently and identically distributed, that's statistical lingo to say that they're unrelated to each other, and they've got the same risk-reward profile, then it turns out that the standard deviation goes down from 423.5% to about 35%. 35% standard deviation, 12% return. How many of you want a piece of this fund? Yeah, looks more interesting. I've now raised a little bit more money. But can we really raise $30 billion? And the answer, again, from an economic perspective, is not surprisingly, it depends. It depends on a bunch of stuff. In particular, if I had 150 of these projects that are independently and identically distributed, each with a 5% probability of success, I can actually finance this using debt, issuing bonds, cancer bonds. How much can I issue? Well, it depends on what my default rate is and my probability of success. If I had 150 projects, each with a 5% probability of success, and they're all independent, the probability that I get at least 3 successes out of 150 shots on goal is 98.18%. I've got a 98% chance of getting at least 3 hits out of 150 tries. And with 3 hits, what's my portfolio worth? Well, 3 times $12.3 billion in year 10, or about $37 billion. And if I issue bonds that have a face value of $37 billion in year 10, how much am I going to raise today? Well, it depends on what the yield is. According to the average index for the AA rated bonds as of a couple of days ago, the yield is 2.41%. That gives me proceeds of $29 billion today if I issue 10-year AA rated bonds. How do I know that it's AA rated? Well, what's the default rate of AA? Historically, it's a little bit more than 2%. And by the way, 2% is exactly the probability that I won't get at least 3 hits. That's where I got the AA rating from. And if you allow me to use all the other tricks of the financial trade, like collateralized debt obligations, credit default swaps, and all the other things, I can do even better than this. Now, I know what you're thinking. Really? Is that really a good idea? I mean, didn't these techniques play prominent roles in the financial crisis? And the answer is yes, they did, absolutely. And it was actually the financial crisis that got me thinking along these lines. Because the financial crisis happened not because these techniques didn't work. It happened because these techniques, they worked way too well. These are really powerful tools for pumping tremendous amounts of money into the financial system over a short period of time. When that's done irresponsibly, thoughtlessly, you can get disaster. But if we're careful in how we use these tools, we can make transformational changes. And it's really driven by the statistics of the problem. So here's the basic statistics. If I've got 150 uncorrelated projects, each with a 5% probability of success, the chances of at least getting at least 3 successes is given by this 98% that I just described to you. That's assuming that they're independent. However, if they become dependent, if there's a 10% correlation among the projects, then you don't get 98%, now you're down to something like 90%. If the correlation is 40%, now the probability of at least 3 hits is a little bit more than 55%. And if the correlation is as high as 80%, now you're looking at a less than 25% chance of at least 3 hits. At that level of correlation, nobody will buy your debt. It is going to be way too risky. You cannot finance the projects in this manner. Correlation is the absolute key to all of this. When I showed this calculation to one of my pharma friends, he said, you know what, this is what I've been telling my colleagues for years. And the analogy that I use is my daughter's 3rd grade soccer team. And I said, how do you mean? And he said, well, you know, I'm the coach of that 3rd grade soccer team. And have you ever coached 3rd grade soccer? And I said, no. And he said, well, this is what it looks like. All the kids, they crowd around the ball. And you got to tell them, no, move out, move out. Don't go to where the ball is. Go to where the ball will be. It's really hard to get them to do that. When you compare this to World Cup soccer, you see the difference, right? If we all crowd around the same kind of projects, the risk is very high. But if we're able to diversify and spread out the way that finance theory teaches us, we can lower the risk, increase the odds of success, and then finance it using different kinds of financial instruments, instruments that are capable of bringing enormous resources to bear on this challenge. So from the economic perspective, our work is done. The rest are just details that you guys figure out how to implement. And so, you know, I actually gave a talk back in 2010 on this idea. It was at that time just back of the envelope scribblings, just what I showed you. And I just assumed that people would take the idea and run with it. And not surprisingly, nothing happened. And so I realized it's because, you know, there are a lot of details. Things like, do you really need 30 billion? Is that the right number? Isn't pharma already doing this? Why are we getting involved when the experts are supposed to be focusing on this? Can we afford the new therapies? Aren't they very expensive? And pricing is going to be an issue, and on and on and on. And so I didn't have answers to any of these questions, being outside the industry. But because I was really driven by these personal reasons, dealing with my grief for all the people that I left, that I lost, I was left to my own devices of trying to come up with answers to these. And very fortunately, I had a number of talented collaborators, some of who are in the audience today, from the biomedical field to help me think through these issues. And so given the limited amount of time, I'm not going to take you through all of them, but I want to answer at least 2 or 3 of the biggest questions on your mind. And so let me start first with the, do we really need the 30 billion? And the answer, of course, is it really does depend. It depends on a bunch of things. It depends on how much it costs to develop a single compound, how long it takes, the duration of the various different phases, the number of people involved, the correlation among the shots, and the profits that you get if you succeed. All of those parameters we put into a Monte Carlo simulation, and we put that simulation software online with an open source license. Anybody can take it, steal it, use it however way you want, and take it out for a spin and try it out for yourself. What we're hoping to do is to get more people to see whether or not our assumptions, which we got from the industry, make sense. What we discovered is that what is really needed in this space is a collaboration between biomedical experts, people that are in the field, and financial experts, people who understand how to use these kinds of powerful tools. And that's what we've been doing at MIT for the last 5 years or so, is bringing those kinds of resources together to collaborate and come up with concrete answers to these questions. So the short answer to this question is that actually, for certain things, $30 billion is way, way, way more than you need. And for other things, it's not nearly enough. So if you want to deal with Alzheimer's disease, Alzheimer's is a really, really challenging set of problems. We don't even understand the basic biology of Alzheimer's as a disease. For Alzheimer's, $30 billion is not nearly enough. You need probably close to $100 billion to deal with that disease. But there are a set of diseases for which even a few hundred million actually works really well. And so we've written a series of papers published mainly in scientific journals, not in finance or economics journals, that try to highlight what parameters are relevant for the various different kinds of diseases. And by the way, I should mention, the reason that we don't publish in economics or finance journals is not because economists or financial experts are somehow skeptical of this. It's because all of the research that I've done over the last 5 years in this area, there is absolutely nothing new from the financial or economic perspective. Now, this is a terrible thing for an academic to admit. Usually we pride ourselves on novelty, right? I remember still to this day, when I was a grad student, I was walking down the hall and I saw an assistant professor cursing and screaming and really upset and holding this letter in his hand, shaking and completely red. And I couldn't help it. I went up to him and I asked him, what happened? And he said, well, his major paper that he'd been working on for 4 years just got rejected by a journal. And he was holding in his hand the referee report. And the referee report was like 2 sentences. And I said, would you mind if I read it? And he threw it at me. Yeah, you take a look. The referee report said this. It said, this paper is both interesting and original. Unfortunately, the interesting parts of it are not original, and the original parts of it are not interesting. So rejected. I remember that. And so I want to tell you up front, what I've done and my co-authors have done, it is both interesting and original, but the interesting parts are not original. All of the stuff that we've done is basic finance 101. Those of you who took my 401 course, you can do this too. You could have written these papers. In fact, the very first paper was written with a Sloan Fellow student, Jose Maria Fernandez. What's new is applying this to the biomedical context. And in the most recent paper that we published just last year, we actually applied this to a portfolio of drugs that have been developed by the NIH. Now, the NIH usually isn't involved in drug development, but they have a smaller group called NCATS, the National Center for Advancing Translational Sciences, that is charged with the responsibility of focusing on rare and neglected diseases. These are the diseases that you or your children may have that doctors don't even know what to diagnose, that nobody knows what the answers are. The NIH is your last resort. They have a clinic there, and they deal with these kinds of last resort type of situations. And they've got 28 different projects that are focused on rare diseases, diseases that affect patients of 200,000 or less. And so we asked them if we could have their data. Can we look at your 28 projects to see what would happen if we stuck them to a portfolio, if we valued them using venture capitalists to come up with valuations, and if we used basic hypothetical financing to calculate what rates of return stock and bondholders would have gotten had they invested in you, NCATS. And they said, sure, here's the data. We published this, and the answer is, for the equity tranche, we got an IRR of 22%. 22%, that puts hedge fund managers to shame. And that rate of return was based on a $500 million initial capitalization for the fund. So in this case, you don't need 30 billion, 500 million will do quite well, thank you very much. Question, yes?
So, correct me if I'm mistaken, but you're saying that part of your strategy to raise capital is to access the debt capital markets. What have you done to socialize, a lot of what you just said, either to the investment banking community, because it takes them a while to kind of get used to the idea. And when you say 23%, are we talking about risk adjusted?
I'm talking about the raw rate of return, the actual realized rate of return for the simulation, yeah. So we've actually done quite a lot to try to socialize it, and you're absolutely right. Socialization is really the key, in fact. So if you don't mind, let me come back to that, because I'm going to talk about what's been going on and how the socialization process is going. And part of that process is why I'm here today. So this is part of the socialization process. So I'll come back. Thank you for the question. Okay, so last thing I want to talk about regarding orphan diseases is this. The economics of orphan diseases are very different than, say, cancer. Why? Because it turns out that cancer is actually not uncorrelated across projects. If you've got 5 anti-angiogenesis compounds, these are compounds that limit the growth of blood vessels that feed tumor cells. If you starve the tumor cells from these blood vessels, you will actually be able to eliminate the tumors in some cases. If you've got 5 of these different projects and one of them fails, guess what? That's not good news for the other 4. They're correlated. But with rare diseases, of which the vast majority are random genetic mutations, typos in your DNA, the typos occur randomly. So just because you fail to find a therapy for one typo says nothing about whether or not you can find a therapy for another typo. They are statistically independent. The IID assumption is actually almost perfectly true by the biology of these rare diseases. So now, instead of 150 projects, let's suppose we only have 20, each that are independent but with a probability of success P that I'm going to vary. So now I'm going to assume that the correlations are 0, but I'm going to vary the probability of success from 5% upwards. At 5%, the probability of getting 3 hits is exceedingly low out of 20, right? 20 shots is not a lot. But if the probability of success is 10%, the likelihood of getting at least 3 hits is 30%. If the probability of success is 15%, it's still higher. And 30% probability of success, you're talking about a 96% probability of at least 3 hits. And many experts tell me that for rare diseases, the probability of success in some cases is as high as 80%, because if it's a single gene mutation, you know exactly how to target therapies for dealing with that single mutation. The question is, if we're talking about small patient populations, is it really profitable to do this? Are pharma companies going to want to do this? Well, not initially. But guess what? Over the course of the last few years, all of these drugs have been approved as rare disease drugs, according to the Orphan Drug Act of 1983. Some of you may actually recognize some of these drugs. Herceptin is a breast cancer drug. Now wait a minute. Breast cancer is hardly a rare disease. 230,000 women are diagnosed with breast cancer every year. 30,000 women die of it each year. How is breast cancer a rare disease? Well, thanks to the miracle of gene sequencing, we are now able to identify molecular biomarkers, genetic signatures, that will basically divide the population into subcategories. And if you have the right genetic makeup, Herceptin will work like a charm for you. And if you don't have that genetic makeup, this drug will not work at all. We're not going to even prescribe it to you. So we're actually able to divide and conquer the patient population into substrata. And that makes drug development a lot more efficient, a lot less risky, a lot fewer side effects for patients that really can't benefit from the drug. So the entire field of drug development is changing dramatically. By the way, Keytruda is the drug that saved Jimmy Carter's life. That was approved just in 2014, a year before Carter got the drug. And it was approved as a rare disease drug. So let me talk now very briefly, because we're running out of time. Isn't pharma already doing this? In a way, pharma is kind of like these big mega funds that I'm talking about. If you take a look at Pfizer's balance sheet, Pfizer has $34 billion in cash, of which $32 billion is financed by long-term debt. So Pfizer looks like a mega fund, doesn't it? Except that they're not spending their money on early stage R&D. What they're doing with their cash is they're going shopping, and they're looking to acquire companies like Hospira. They tried to acquire Allergan, but we put the kibosh on that because of the tax inversion. And so pharma companies are actually doing less and less R&D. And the reason they're doing that is because we shareholders are telling them to do that. In 2010, Morgan Stanley put out a very influential research report on how to deal with that lost decade in the pharma industry. And what they're telling us is the title of the research report, Exit Research and Create Value. Our solution, our economic value analysis, supports replacing research with search. So instead of doing it in-house, buy companies after all of the risk has been taken out of them. And you know what? Pharma is listening. Just to give you an example, within the last 5 years or so, pharma has cut over 140,000 jobs from the books, most of which are in R&D. And here's a classic example. What happened last year, right here in Cambridge. Biogen decided to lay off 800 people, most of them in R&D. Why? Because they wanted to save their cash so they could fuel their sales team to sell their drug Tecfidera, focusing on that black line, that low-risk, high-return part of their business, and getting rid of that more volatile business. And you know what? After they did that, their share price went up. They're maximizing shareholder value. So clearly, it's having an effect. Pharma is doing better, but that's not necessarily in the patient's best interest. So new business models are emerging, and here's where the socialization now comes in. Within the last couple of years, these ideas of portfolio theory and debt financing are starting to take hold, and we've been talking to both investment banks as well as biotech VCs, as well as anybody else who's willing to listen to us, that these new methods can actually be used to raise money. So back in 2015, an early stage venture capitalist, Pure Tech Ventures, based here in Cambridge or in Boston, they did an IPO for a venture capital company on the London Stock Exchange, raised $171 million for an early stage biotech fund. Malin, another company that was a portfolio company, they decided they were going to invest in a large number of biotech companies. They did an IPO on the Irish Stock Exchange and raised 330 million euros. And part of that was basically just announcing that they were going to create this portfolio of projects, not describing any one project in particular, and the government actually provided them support. The City of London actually heard about our proposal, and they decided they want to push forward a $15 billion mega fund for London to focus on life sciences. That's still in the process, so they're having meetings about it and hoping to push that forward. We'll see how it goes. And just a few weeks ago, UBS announced a $471 million oncology impact fund that is going to be focused on early stage life sciences research, targeting that valley of death. And it is structured in a way that's really different from your typical venture capital fund. And last but not least, with regard to that study we did on orphan drugs with NCATs, as part of that study, we brought down some hedge fund managers to meet with NCATs when we produced the final version of our findings. And these hedge fund managers came along with me because I wanted to illustrate that there was appetite for making these kinds of investments. These were the folks that helped deal with some of these valuations. The day after we got back from that meeting at NCATS, one of the hedge fund managers sent NCATS a letter of intent saying that we would be happy to invest $500 million in your portfolio if we can get access to some of the intellectual property and be able to benefit from it. The folks at NCATS was blown away. They did not know what to do with that because actually the NIH is not authorized to do public-private partnerships. But it turns out that Congressman Vargas from San Diego heard about this effort, got very excited about it, and he actually introduced legislation late last year giving NIH authorization for a public-private partnership. Now, this has been introduced as a bill. It hasn't been voted on yet, but the hope is that when Congress becomes functional again, maybe we'll be able to deal with that. Since we're running out of time, I want to just talk about one last thing, which is can we afford these therapies? Because they are very expensive. And for a brief period of time, you've heard about this, the most hated man in America, the person who jacked up prices on various patients by 5,000% at Turing Pharmaceuticals. So the first point I would make is that, you know what, there's a difference between price gouging, which is not acceptable in any industry, and the pricing of expensive breakthrough therapies. And the case in point is hepatitis C, a disease that previously had no drug for it, and that would ultimately require you to get a liver transplant. It would cause all sorts of problems. We now have a drug that can cure hepatitis C. It is a one-time treatment, 12 weeks of pills, and you are done, cured forever. How much would you pay for this? Well, let me tell you before you answer that the cost of a liver transplant in 2011 was $577,000. And if you don't have one of these things, you will eventually die of the disease. And what's the cost of a death? Well, it depends on what the value of a life is. And statistically, I can tell you, according to the US government, the value of a statistical life is $9.1 million. That's what we use when we make policy decisions about highway speeds and other kinds of protections, $9.1 billion. And so if you take 2/3 of it, assuming you find somebody who's in their 20s that has hepatitis C, and they're living just 1/3 of their life, and they got 2/3 left, you're talking about a $6 million savings. So how much would you pay for this bottle right here? A one-time cure for hepatitis C. 100,000, 200,000, 500,000? More. Well, here's the price, $84,000. What a bargain. Really, right? I mean, you know, $84,000, you're done. But when this was announced, it was considered an outrage. The Senate brought the CEO of the company, Gilead Sciences, and basically reamed him for being so incredibly callous as to charge these outrageous sums. From an economist's point of view, it really didn't make sense until you realize that there are 3 million patients today that have hepatitis C in the US. If you want to treat all of them, you're looking at a $250 billion price tag. Who wants to write that check? That's a lot of money. But the problem is that it's a one-time payment. Well, we all know how to deal with one-time payments. Students of my 15401 class, you've seen this formula before. That's the mortgage formula. Take a one-time payment and spread it out. You can actually create healthcare loans that will allow you to mortgage these kinds of expensive treatments. And by the way, hepatitis C is not the only treatment that's going to be like this. Gene therapies now are on the verge of being introduced that can cure you or your children from these terrible, debilitating diseases. And when that happens, you're going to see a lot more therapies. You're going to need these kind of payments. So the title of this talk is taken from the paper that we published just a few weeks ago, Buying Cures versus Renting Health. That's the trade-off. It turns out that you can use finance to be able to make very expensive therapies much more affordable, both to insurance companies as well as to patients if the insurance companies won't pay. Using various different profiles for various mortality rates of this disease, using student loan populations to calculate default rates, we actually simulated a securitization of healthcare loan portfolios and show that there's a lot of room for being able to lower the cost of borrowing, to get investors reasonable rates of return, and to get a lot more money to patients sooner rather than later. So let me wrap up by saying that, you know, these methods in finance, they have mixed reception, because when you're talking about life and death issues, and in the same breath talk also about rates of return, it can be very offensive to people. My mother died of cancer, so I get it. I understand why people are offended. But the problem is that if we don't talk about rates of return, we're not going to get the funding that we need. And if we do, we can have tremendous impact. And so I want to leave you with a vision that really changed my life and made me think very differently about using finance for these different purposes. And the story has to do with this man, a biologist by the name of Harvey Lodish, who is a member of the famed MIT Whitehead Institute just across the street. When I heard about Harvey Lodish's story, I decided then and there, I want to be Harvey Lodish. And you will too when I tell you the story. In 1983, Harvey was approached by a venture capitalist looking for a partner to help him develop a therapy for a rare disease called for Gaucher syndrome. Gaucher syndrome is another one of these genetic disorders, a typo in your DNA that prevents your body from producing an important housekeeping enzyme. And without that enzyme, fatty substances build up in your organs, causing bone problems, your spleen will fail, and eventually, by the time you reach your 20s, you're dead. Well, not anymore, because Harvey was able to develop a method for replacing that missing enzyme. And in 1991, the drug Ceridase was introduced. And since that time, and through improvements in that drug, many tens of thousands of Gaucher patients have been saved. And you might have heard of their little company. The company is called Genzyme. And in 2012, they were acquired by Sanofi for about $20 billion. No, that's not why I want to be Harvey Lodish, although that's not a bad reason. I want to be Harvey because of what happened in 2002. You see, in that year, Harvey's daughter became pregnant with her first child, Harvey and his wife's first grandchild, a boy named Andrew. In utero, Andrew was diagnosed with Gaucher syndrome. What are the chances of that? Now, just because you've got the genetic marker, it doesn't mean you'll get the disease. But when Andrew turned 10 in 2012, he started developing the symptoms. But he's just fine, thanks to the drug that Grandpa developed. This is why I want to be Harvey Lodish. You can imagine that Harvey's a pretty popular guy in that household. Pretty cool, right? I can't, because I'm not a biologist, I'm not a drug developer. But you know what? We can all be Harvey Lodish if we invest in a fund that develops the cures for our grandchildren, whether they be Alzheimer's, diabetes, or Gaucher's. We're on the verge of some incredible things, and we just need to get over the finish line. Finance doesn't have to be a zero-sum game if we don't let it. We can actually do well by doing good, and with all of your help, with the proper socialization, we can actually do that now. Thank you. Do we have time for some questions? Maybe we have time for one question? Yeah, back there. You were first.
So, I can't help, class of 91. Everything behind this is awesome. But I can't help but ask, when you think about lysosomal storage disorders, other rare diseases, disease child, you can sequence the genome. Why not take $2 billion, put in CRISPR-Cas9,
Yes.
correct the genome before you're born with the diseases, before you're charged $300,000 a year for a cure? Because as you mentioned with Harvey, in 91, he was collecting 2,000 placentas a year for the drug. Now he's simulating it, in a simulator and still charging $300,000 a year.
Right.
Why not go right to the source?
Absolutely. So let me back up and explain what that question was. It's a very sophisticated question, and it's exactly the right one to ask. There's a technique that was developed maybe 5 years ago, I think it was, maybe even less than that, called CRISPR-Cas9. It's a particular method for gene editing that basically allows you to change the typos in the DNA before the child gets born, even before inception occurs. It's an incredible technology. It's not ready for prime time yet. In fact, even the patents surrounding this technology are in dispute. One of the developers is at UC Berkeley. Another one of the developers here at MIT Whitehead. And they're actually battling in terms of who owns the patent rights to that. Now, you might think from a patient's perspective, who the hell cares? Let's just figure out how to use it. But the world doesn't work that way. If and when we get that patent issue sorted out, it will become commercialized almost immediately. It's already being done by companies out there, even without the patent dispute being resolved. And you're absolutely right. This is what I mean when I say biomedicine is at an inflection point. We are now in the position of being able to identify these typos, associate them to phenotypes, to certain diseases, and to fix them before they ever cause problems for us. It's an incredible time for us to be alive. And it's also an incredible responsibility. We're almost at that stage yet, but it's going to require literally hundreds of billions of dollars in order to get there. And by the way, we happen to have hundreds of billions of dollars. They're in the debt market. You got to go there and get it. And with all of your help, we can actually do that. Thank you.